Maybe let's start with you, Vanessa. Just a brief introduction of yourself and the company would be great.
So I'm Vanessa Muscara, Head of Research and Strategy at Europa Capital. We are, as the name suggests, a pan-European investment manager. We operate across a number of risk profiles, so we manage a number of core and value-add funds. We're 25 years young, and we're 75% owned by Mitsubishi Estate Corporation, who in turn have an AUM of 100 billion.
Super, thanks very much. Dirk.
Yes, my name is Dirk Hennig. Welcome to everybody. I'm the real estate valuation leader for PwC here in Germany. We have a designated real estate team with more than 450 people in Germany, dealing with all services around real estate, not only valuation, it is deals, M&A, tax and legal advice as well. And the whole practice is also involved in the global PwC real estate practice.
Great, super. Reiner.
My name is Reiner. I'm a general manager of HypZert GmbH. It's a company who qualified and certified valuers who are working for the German financial industry. And my second hat is general manager as VDP Research, where we drive a transaction data bank and got data from more than 800 banks.
Great, super. Thanks very much. Johannes.
Hi, everybody. My name is Johannes. I'm a team member of Dirk's PwC real estate department, and I'm kind of heading together with him the ESG valuation impact assessment here within PwC Germany.
We're focused here on valuations and the measurable influence of ESG in terms of value. I suppose, Dirk, just starting with you, how do you see that from your point of view?
First of all, I believe we have to answer three questions. The first question is, do we have an impact on real estate values? The second one is, how do we rate ESG in terms of valuation? And the third one is, how do we bring it to numbers? Yeah. For the first question, I would say, yes, we definitely have an impact on real estate values if we have a difference between ESG good buildings and ESG poor buildings. Second one is, we have to think about how can we do assessments for ESG ratings. Yeah? And we do not talk about just one property or one building. We have to think about the global portfolio. And here we are talking about millions of properties we would have to do to come up with an opinion on an ESG rating. And the third step is, I can elaborate a little bit later, how do we plan to bring this ESG rating into an ESG real estate valuation, where we, to be honest, are still on the starting line, and we have to do still many steps to come up with a market value considering ESG in terms for transactions purposes, but also for balance sheet purposes.
Great. And Vanessa, I wanted to pick up with you just how you see this valuation side of it. And also there's a lot of discussion around ESG, around carbon neutrality and those kinds of things. But how do you see the influence, particularly on valuations?
I guess there's two sides to the story. There's the investor story and then there's the occupier story. So on the investor side, there is academic, albeit applied academic research, which proves that it was actually a PhD paper by the University of Toronto dating back to 2017. And they won the IPF INREV SPR Applied Research Prize that year. And they took a sample of US REITs and they divided across all sectors into certified and non-certified buildings. And they proved that the certified buildings achieved a higher distribution yield to the client. So even though the operating expenses were higher, the rental income was higher. It compensated for the relatively higher operating expenses to produce a higher distribution income yield to the client. So that's all very well, but what about occupiers? What's in it for them? Well, I guess we're at a point in time where returns are driven by income. So I suppose it's in our interest to keep occupiers happy. And there was, I believe, a survey which was undertaken by Cushman & Wakefield late last year. And they found that if we are to work from home every day, the top challenges among occupiers was subpar connectivity, inadequate workspaces, and caregiver duties. So I guess the point is that when we do go back to the office, we want to be as productive as possible. And again, sorry to mention another academic paper, but this one's by University of Harvard. And they took a sample of certified and non-certified buildings, high performing, but they found that the tenants which occupied the certified buildings, they achieved 26% higher cognitive scores and 8% higher sleep scores. So these tenants went to work feeling, more productive and more restful.
Interesting. And that's very different to that idea of looking at space as the valuation based around square meters and those kinds of things, but actually what's the impact on your largest cost in a way, which is your human talent that you've got inside the building. That's really interesting. Reiner, I just wanted to pick up with you, obviously in terms of the certification and those kinds of things. What are you seeing? And I suppose what helps people implement and deliver some of these effective strategies?
Yeah, I think it's complicated. I mentioned that we certified more than 2,000 values, and if you ask them what can we do, and we heard from the analysis and the studies, but we have also our transaction data bank, and we made some analysis in the last 5, 6, 7 years, every year once again, and we saw no statistical evidence that we saw, okay, if it's a building more efficiency, it's the rent is higher, is the quality good, okay, you have a higher rent, but statistical evidence we didn't see, and I think that is a problem to transfer this information to the valuers and to say, yeah, when do you take 20 euros or 21 euros, what is necessary? And of course we had some added regulatory requirements of EBA guidelines and EZB guidelines and the BaFin Merkblatt or BaFin Leadfile. But all these guidelines are very general. They don't say you have to look after for the first to this, second to this, second to this. And that means that the industry have to look how they can go forward. And
Johannes, we've obviously seen more regulation coming through today. What's your sense of how, I suppose, this could be driving valuations going forward?
It's a good and fair point. As you may know, the EU taxonomy has clearly some strict a strict framework providing to kind of benchmark each and every asset, where we can say, okay, based on that legal framework, is it compliant and in a sense contributing to a sustainable built world, or is it not? And I think coming from a valuation perspective, that's the first and main angle which we can take in order to kind of creating an idea how the valuation is impacted, and in a way that either we are or we do see compliant buildings, or we do not see compliant buildings, and that's kind of have to flow into the valuations.
And from your point of view, Dirk, are you seeing more of a move from the valuers, or is it more difficult to introduce that into traditional values?
I think from the valuers, we see a strong demand to understand how can we bring it into valuation. Right now, as Reiner and Johannes mentioned, there's no clear evidence on the market that we can see, and we can recalculate in transactions what is the impact on ESG. Discussions here on the valuation practice in Germany, but also on an international base, we see a good understanding of ESG criteria. And we see also, let's say, strong demand to find models to consider ESG criteria into valuation models. So I'm also part of the tangible asset board at the IVSC, so also on the global standards that we have discussions going forward in this term. But it is still, let's say, the big challenge. What is the market impact, and how can we bring it into valuation practice? On the other hand, we see it analyzing listed real estate companies. That there's a clear trend in market cap, also in the risk adjustment and on the growth assumptions. If you are one of the leaders on ESG as a real estate company, you get a better performance on market, which will end up finally also on a better financing for your future investments. So that's one of the kickbacks you get when you invest on an early stage and in a transparent way in ESG. On the other hand, I would like to point out ESG is not something totally new. So from a responsible investor's view, taking care of your investment, taking care of your real estate, make sure that the energy consumption is going down, that you have very good standard in your building, which has an impact, as Vanessa mentioned, also on the people who are working in the building. That's something which is normally common and should be also common, but now we get in a phase with more transparency. Yeah, we have defined criteria to benchmark it, to assess it. Yeah, and I think that's a new world where we have to learn how to deal with it and finally bring it into a world of numbers and values. We can also do benchmarking, and everybody can also, let's say, have his own action to become better in the market than before. And I think that's a big win of the ESG campaign. And
Vanessa, from your point of view, I suppose on the investment side, obviously there's an aim to put in, I guess, as much value as you can into buildings, but how does that work in terms of occupiers? Are you driven there really by the occupiers demanding this kind of ESG compliant buildings, or is it driven more by regulation? Is there a value in getting ahead of the market to some extent, or are you really kind of working on what occupiers want in a particular country or region?
Let's go with the occupier then, what they want. I guess the way I try and explain it is by using something called the Keller's theory of customer benefits. And I like the way that our industry is talking about tenants in terms of customers, because returns are more and more driven by income. And so Keller's theory is actually a marketing strategic theory. And it says that we pay for any product or service in relation to 3 types of benefits. It has to be functional, it has to be experiential, and it has to be symbolic. So if we take an office as an example, it has to be functional in the sense that it needs to be safe in terms of fire safety. I need to be able to do my work in it. It has to have power. It has to have basic amenities like toilets, for example. And then it can be experiential. So maybe it has beautiful views. It has, if I'm lucky, it has designer furniture. And then it can be symbolic in the sense that pre-pandemic, take a green office building in this case, perhaps pre-pandemic, I'd like to be seen as working in a green office building. I'd like to be seen as saving the world. And I think that post-pandemic, it's not a question of certified office buildings being symbolic. They also have to be functional in the sense that they also have to work for the occupier in terms of air quality and making me feel safe, also in terms of air quality technology. That said, there's certified and certified. You have, for example, BREEAM certifications. You can have outstanding all the way down to unclassified. So in terms of passing on the cost to the occupier, you need to choose a level of certification that reflects the local market price point. And then from the investor side, I guess there's, if you look at the INREV universe, for example, the capital values towards the end of 2020 for offices, they lost, I think they fell by 20% quarter on quarter. So there's an opportunity there to reposition non-core assets to core assets to get them certified, for example. And if you think regionally, if you look at select cities globally, North American cities have a higher share of office stock. So the city with the highest share of office stock is Chicago. 70% of office buildings there are certified, as opposed to Europe really has some way to go. In Europe, the city with the highest share of certified stock is Warsaw at 21%, but it's still much lower than, say, Chicago at 70%. And Warsaw is actually a bit of an outlier because most of the data we have is modern stock. So there's a lot of cities that are doing worse than that. That said, another opportunity for investors is the fact that So in terms of age composition of offices across Europe, 60% of offices in Europe are over 20 years old. So there's an opportunity to buy non-core assets who have lost in value 20% according to INREV in the last quarter 2020 and reposition them to core as some sort of certified status.
Okay, good. And Johannes, I suppose, how do you see, I mean, there was a discussion in the earlier panel a little bit around that embedded carbon aspect, and that in a way picks that up, I think, from Vanessa there in terms of the standing stock. How do you see that in terms of valuations, that difference between standing stock and new build, and will there be a way of putting valuations that reflect embedded carbon into that? Where are we with those kinds of discussions?
If we start with the question around existing stock versus new stock, I'm totally with Vanessa that there is an opportunity for investors and also for the current owners in in terms of refurbishments and kind of bringing the asset up in a way that it is certified or it is taxonomy compliant or whatever, but in some way bringing the whole ESG aspect into the building and then kind of have a new positioned building which is more attractive for occupiers and also for more investors, because that's kind of the difference, right? We have the old stock where you have that limitations, and you have the new stock or a refurbished one where you kind of have a broader investor and occupier universe. And the question around embedded carbon, I mean, that's kind of very interesting one, and I kind of would like to hand over to Dirk for that, because I think we had some discussions around embedded carbon within a real estate company here in Germany, and I think they really take that into their accounts, didn't they, Dirk?
Yeah, let's say from the earlier discussions we had when we started with ESG, there was a fiction saying all new build buildings have an advantage compared to the existing stock. But when you imagine what is happening and which resources will be used to build a new building, you have all of this concrete, cement, bricks, and stuff like that. Steel, there's a lot of new CO2 consumption we would bring to on Earth. Yeah? On the other hand, when we are responsible investors and we have already a good stock in place, all of those investments are already done. So the CO2 is in the buildings, and there is no new emissions. So there is, let's say, a very good chance, and also I think a responsible way to use the existing building stock, but bring it in a modern ESG-conform standard, yeah, to fulfill on the one hand side also energy, social, and governance criteria. On the other hand, also what Vanessa pointed out, that we have an environment for people working or living in such a building to have a modern style, yeah, as state of the art. And I think that's the balance, and we have to be fair in the CO2 discussion. Embedded carbon, what is already in, and what would be probably used when we start with greenfield investments everywhere. So I think this balance needs to be bring on screen. And what is also, let's say, critical is how can we measure embedded carbon? I think that's a good challenge. There are already some criteria and studies available to calculate the embedded carbon. It's also interesting from an accounting perspective how to deal with it. And on the other hand, we need to understand what is the future carbon we will release over the period of time when we use a building. And here we are, let's say, in both ways. This is also, let's say, CO2 coming from the building as itself, but also from the operators on the other hand, and how responsible are operators dealing with, or users of a building dealing with CO2. So that's a long way to go. But we should make it transparent and bring it to discussion.
Reiner, from your point of view, I mean, Vanessa there mentioned a lot around the sort of social side of things. How much is that playing into certification at the moment? And I suppose, what's the role of the sort of S element of it to a certain degree? And because that's certainly being considered much more in terms of valuations going forward, it would appear.
Yeah, there is one sentence who said the valuers are not responsible for the weather, they reported about the weather. And what does it mean? That means if the industry is not so far that we said there is evidence that this brings this euro or this capitalization rate or something like, so far as the valuers are not in a position to bring it in its daily work in euros or in capitalization rate. That means it is necessary that someone is starting that this evidence from the building into euro or into the capitalization rate will start. And I think that PwC started with a tool which goes in this direction. And I hope that PwC will go forward. Which details, which instruments are in it, and which factors we have to analyze, and maybe in a year we are a step forward.
If we return to the question, which is, what's the measurable influence of ESG on drivers of value? It looks as though we're beginning to get different elements coming in from Vanessa there, mentioning those. Mentioned there, Dirk, as well, of tools that PwC have got. So what are the things that we can measure at the moment, and where do we think that's heading?
Yeah, there are some aspects like which are linked to the building, but also linked to the nature hazard and climate change. And if you allow, I can say 2 or 3 sentences to Carl. Carl is a solution or a tool for understanding and managing these risks, and it was worked out by the Cologne Assekuranz. It's a daughter of Munich Re and Ergo, and they worked on a tool where they analyzed 8 different hazards: volcanism, tsunamis, earthquakes, storm surge, flood, tornado, hail, and heavy rain. And in the end, you got a result which is which risk do you have, and then which probability and intensity is it? Then they looked into the environmental conditions and the so-called vulnerability. That means how much is the damage, and in the end you get a risk at the location. That means you get a risk index and a so-called PML, probability maximum loss, which is a number in euro or in occurrence worldwide.
That's really interesting. Maybe what I'll do, Reiner, is also get some more information around that, because we're limited for time now to go through with that. But I think that might be something that attendees would be interested in. So I'll get some more information on that, and we'll be able to forward that around to everybody, because it's quite an interesting area. I think that the resilience side of it and the impact of climate change from a risk perspective in terms of some of the built environment. Johannes, how do we manage, I suppose, some of those elements, the difference between looking at resilience, versus looking at some of the areas that Vanessa was talking about, which are really opportunities, I suppose, for the built environment to outperform where it is at the moment, and maybe charge more, just like a 5-star hotel charges more than a 2-star hotel.
That's a fair question, but from the risk assessment, I would assume that going forward, buildings have to take into account certain risk around, let's say, unique events, like Reiner just mentioned. And if there are, let's say, protected against those unique events, you probably have an advantage, and if not, you kind of have a disadvantage. And I think that will trickle down into at the end into the valuation, or at least into the demand for the building, because you kind of either way are protected or not against certain unique events.
Let's maybe start with you, Dirk. Just in terms of the the key aspects, whether you're an occupier or an investor or financing these assets. What are the key things from your point of view?
I think we need clear criteria. How can we measure it? We need a more balanced global tool to say what is ESG and how do we assess it in terms of real estate, differentiated between property, residential, office, logistics, stuff like that, and that also the user understands what is with the building. Yeah, which criteria does the building fulfill? And I think the user is every time a very good benchmark and also driver for such an assessment. And at the end of the day, I'm sure that the financial market, the investors, will really value in a positive sense if you fulfill criteria and you are in line with ESG and even doing better. Okay,
great. Reiner, what are your sort of key aspects there?
Yeah. I expect that the profession of the valuers will change away from the classic valuer towards to a consultant. That means in the last year he spent a lot of time to collect data and maps and etc. And these are increasingly delivered by clicks. And the valuer has the necessary time to process and analyze these data and the influence and advise his colleagues, in my case or in our case, the colleagues of the grid department. That means we have to work that the criteria, the data of the criteria, which, for example, Mr. Hennig mentioned, that these will be delivered by a click, more or less.
Thanks very much. Johannes?
I think going forward for the real estate valuation, the let's say ESG compliance and also the legal aspect here in Europe will be play a key role for the valuation, because it provides a clear, understandable framework for each and every asset Europe-wide, and also we heard that in the last panel that other countries considering that framework for the ESG assessment as well. So I think and that's kind of in line with Reiner looks, the valuer going forward has to really understand the regular framework, has to understand the market requirements with reference to ESGs, and has to take that into account, whether it could be lower or higher rents, or whether it could be lower or higher yields based on the direction in which the building is leaning in terms of ESG.
Okay, great. And Vanessa?
As Johannes was saying, it's all about managing risk. And so we're at a point in the market cycle where performance is driven less by fundamentals and more by structural changes, albeit there's no industry consensus on how to forecast structural changes. So the only thing you can do is minimize the risk around those changes. And if we can prove that ESG buildings, so certified buildings, are more resilient, provide a more sort of resilient income stream, then so be it. And I'm aware, and I'm really looking forward to INREV's new ESG pilot study. So they're working with GRESB to link 90% of their indicators to total return performance. So if they can prove that certified buildings are relatively perform better, then great.
Great, thanks very much. Really interesting discussion. And David, thanks very much for agreeing with Reiner that the role of the valuer has changed and is no longer about giving a figure. It's about advice around the value. So I think that's really interesting. Thanks very much for joining us. Thank you to the speakers, and look forward to seeing you for the regulation and legal panel in 15 minutes. Thanks very much, everybody.